Hello everyone, and a very warm welcome to today's Experts for Expats webinar, where we're going to be covering the fundamentals of investing in UK property for expats and non-residents. My name's Alice and I'll be hosting the webinar today. So whether you're looking to invest in UK property with a view to moving here, you're purchasing a second home, you're looking to receive rental income or make a long-term investment, this webinar is going to talk you through the process of buying property in the UK in 2025 and the most important information that you need to know. So we're joined today by a panel of 4 industry experts from the Experts for Expats Partner Network, who are going to guide you through all of the need to knows of investing in UK property, including opportunities in the UK property market, how to navigate property viewings and valuations from abroad, understanding various UK mortgage options, and the tax implications of investing in UK property. So before I hand over to our speakers to introduce themselves, I will just give a quick overview of how the event's going to work today. So this webinar is not just about information sharing, it is also an opportunity for you to engage directly with our experts. So we encourage you to ask questions using the Q&A function and to participate in discussion via the webinar chat. As always at these events, please do not share any personal or sensitive information. If you do need specific help, let us know and we can arrange a formal introduction to one of our experts. As an attendee here today, you are not visible on camera or on audio, but you can communicate with other attendees and ask questions via the chat. To ask a question, just type it into the Q&A and we will answer as many as we can today after we hear from our panel of speakers. So with that, let's get started. Welcome to our panel of experts. I'd like to invite you to just introduce yourself and your area of expertise, starting with you, Henry.
Yeah, thank you, Alice. Thank you for having me. So nice to meet everyone. I'm Henry. I am a chartered surveyor and I am the sales director at Buy Association. I'll get on to what we do shortly. I've spent close to a decade advising overseas investors on how to navigate the UK property market. I had the pleasure of living in Hong Kong for 6 years, which I absolutely loved. It was a great place to live, but that means I've got a large client base and I really know what international investors and what expat investors are looking for when they're looking at the UK property market. More specifically then, so by association, what does this company do? We are known as a UK investment agent, so we're a master agent, and that means that we partner directly with developers to launch their projects worldwide. So we tend to supply the market, and what I mean by that is we will then work with other agencies who will then sell our projects and gain access. So by working with us kind of firsthand, you're gaining direct access to new projects before they're launched anywhere else in the world.
Thank you, Henry. Sarah, over to you.
Hello, and again, thanks for having me, Alice. So my name's Sarah Mottram. I am a buyer's agent, so I do bespoke searches for individuals looking to invest in the UK property market. And also I have another hat on. I'm also an independent financial advisor, so I advise clients on investments and pensions and things like that. Okay.
Thanks, Sarah. Callum.
Hi there, yeah, thanks for having me. My name is Callum Fowler. I work for Fowler Smith Mortgage and Protection as a mortgage advisor. Been doing it for several years and specialising in buy-to-let limited company and expats and foreign nationals.
Thank you, Callum. And finally, Jamie.
Hi, everybody. Thanks for joining us today. My name's Jamie Favell. I'm a partner at Tax Advisory Partnership. I'm a chartered tax advisor and have been advising international private clients for over 20 years. We're leading experts in this field and primarily focus on UK and US expat clients.
Thank you, Jamie, and welcome everyone. So to kick us off today, our first question is to you, Henry. So what is the current state of the UK property market in this post-Brexit, post-COVID world, and where currently are the strongest investment opportunities at the moment?
Very good question. So I'll probably break that down into a couple of sections. I've got some slides to share. This is a graph which kind of shows what UK property prices have been doing over the last 10 years. And you'll see that there's been relatively, well, significant but steady growth over the last 10 years. And even if we look at that over the last 75 years, it paints a really attractive picture. So there are attractive and stable returns to be having in the UK property market with relatively low volatility. So it's quite interesting to look at, okay, well, what's actually behind that graph? What are the key drivers between this price growth that we're seeing? And it always comes down to a very simple fact that demand far outweighs supply. It's a very well documented crisis that we've got in the UK. So a lot of the UK expats on this call will know that there is a housing shortage in the UK. So that is about 4.3 million homes currently. And the UK government have a target of providing 300,000 homes per year for the next 5 years. The problem is we're missing this target. So last year, it was around about 160,000 homes that were brought to market that were built. That was the lowest amount of homes that have been built per year in the last decade. So we're consistently missing that, and that meaning the supply and demand imbalance is continuing to grow. We've also seen since COVID, and to be honest, since Brexit as well, that the cost of building houses has risen fairly significantly. So that's meant that also, just in terms of raw input into the housing market, costs are going up, which is also driving price growth. More recently, I'm not going to steal Callum's thunder, but interest rates have been decreasing. So that's made buying a property in the UK a little bit easier. And that's raised net yield. So that's actually benefited buy-to-let investors. So we'll get onto that. But this is a really interesting graph because no one wants to buy at the top of the market. So what this graph is showing is UK house prices adjusted for inflation. So we're taking inflation into account. And where we can see just on the far right end of the on the graph, this is actually the best time to buy property pretty much since 2013 when we saw that last dip, when you take into account inflation. So it's just quite interesting to see that in terms of time in the market and looking at when is a good time to buy, that works very well at the moment. So that was section one, looking at prices, what's happening, and also what's driving that price growth. That's only part of the picture. So the second part is rental growth. And again, probably more so than price growth, we've seen this huge spike in demand and huge spike in growth pretty much since COVID. And I'll get on to why that's been. But again, it comes down to supply and demand largely. So simple fact is there are more people looking for a home than there are properties that are available. So in Manchester, which I'm going to get onto in a bit, property demand outweighs supply by 5 to 1. And interestingly, one of my colleagues was actually at Manchester University. He gave me this stat. In 2022, 2023, the university was actually paying students to commute from Liverpool because there simply wasn't enough housing within that city centre. So that demand is coming from relative unaffordability within the property market. So I think when you look at median incomes to house price growth, it's about 7 to 8 times what people earn in the UK is the average property price. So they're going relatively unaffordable, and that's what's driving this rental demand, because what we call generation rent, pretty much people aged 21 to 35, they're struggling to get on the ladder, and they're now choosing to rent, whereas rent used to be well, I'll get onto that anyway. But what is actually very interesting is when you look at wage growth is in line with rental growth. So we're seeing that rents aren't growing so much that people can't afford them. Because wages and because incomes are still growing, these rents are still relatively affordable. So that's good for sustainability. I just wanted to have a quick look at sort of what Savills are forecasting for the next 5 years. What we're looking at on the first column, and again, Callum's going to get onto this, but the base rate, so the Bank of England's base rate, which is what sets interest rates for buy-to-let lenders and also normal mortgage lenders, is forecast to decrease over the next 5 years. So that means anyone that's looking at entering the market between now and 2029 is going to be completing in a much more favourable lending environment. In the meantime, we've got positive income growth. So that helps, like I was saying before, with rental growth. It means that it's affordable and sustainable. And GDP growth is also growing in the meantime. What I wanted to look at quickly, and one of your questions was, what have we seen post-COVID? Well, a huge part of what we've seen is a change in demand when it comes to rental trends. So a lot more people now have moved back into these cities and they're living in the city centres. And we're seeing this sort of movement of young populations move back into areas like Manchester, like London, like Birmingham, because of the convenience and what that has to offer. So it was quite interesting because sort of during COVID, we saw a lot more people moving into rural locations. Now, actually, we started to see this urbanisation trend come back in. So there's a good opportunity with city centres, and there's a window of opportunity to invest. because the ability to buy or the ability to enter into new schemes which are currently being built is getting less and less in a city like Manchester and Birmingham, because these plots of land are being developed. So, you know, when you look at central London, when you look at central New York, central Singapore, any sort of well-developed city, there aren't any more development plots to be developed. You know, there's a finite supply of land. So we see a really big opportunity to actually enter a market like Manchester or like Birmingham, whilst that opportunity is still there, because in 5 and 10 years' time, all of those development plots will have already been developed. So looking at house price growth forecasts, I guess this kind of leads me on to my next point of where do we see the most opportunity over the next 5 years? And fairly consistently, the Northwest has led that kind of price growth forecast. So looking at 29.4% over the next 5 years, that compares to 17.1% in London. And as a UK average, that's 23.4%. Where we come in is trying to take that as a base case and say, well, where can we actually outperform those figures? Where are the areas within these city centres that are backed by local government regeneration projects, or where's the new infrastructure coming in? So a great example with Manchester, for example, is the new Old Trafford or New Trafford stadium, which has just been announced. You know, this is somewhere where we're kind of heavily targeting now for all of our projects, because we've got a £1 billion stadium, which has just been announced. If we can get in there, if we can provide our investors with an opportunity to invest now ahead of that completing, that's where you start to outperform the market. So that's me in terms of what I've got to share to begin with. We do see a big opportunity within the regional cities. This is where property prices are a bit cheaper. This is where you can get slightly higher yields. So if anyone does want to have a chat about kind of current opportunities, be more than happy to do so. But yeah, maybe we can get on some questions toward the end.
Fantastic. Thank you so much, Henry. And Henry's going to be joining us again for 2 more webinars, one around resale versus new build on the 27th of March, and one around where to buy in more detail on the 8th of April as well. So we'll send the links around after this as well to sign up for those if you want to dig into those subject areas a little bit more. If you do have any questions based on anything that Henry has said, please do pop them in the Q&A in the chat, and we will come to them at the end in our Q&A section. Thank you, Henry. Our next question is for Sarah, who's also going to be joining us for our next 2 webinars as well. So Sarah, today, it would be great if you could give us an overview of what are the main checks and due diligence considerations that people need to be aware of when they are buying UK property from abroad. So whether that's for resale properties or for new build or off plan.
So there's so much information available these days that you can actually make a really well-informed decision when it comes to buying a property, regardless of whether you're in the UK or overseas. When people come to me, they say they want to buy a property in the UK, I first of all ask them what their reasons for why and what's their end goals. And if it's for family or for personal use, it's slightly different, because that's an emotional decision. It's quite a bit more tricky to find something suitable. Whereas if it's for purely for investment, then actually it becomes a bit more of a numbers game. And actually all that information, you can make quite a good investment just purely based on the facts and figures that are presented to you. So when you say about main considerations and due diligence, they're, regardless of what type of property or what type of investment, there are standard checks that need to be carried out. And this is where you need to get the property professionals and experts involved. So if you need to finance the deal, then, and especially if you're overseas, it could be a bit more tricky. That's where experts like Callum come in. And so you will need to have someone in the UK to help you with that. The legal side of things, you can't get away with buying a property without having a solicitor appointed, and they'll do all the checks for you, environmental, the legal deeds and titles and all that stuff. So you need a professional there. Sourcing the property, it could be very overwhelming, but this is why experts like Henry from Buyer Association exist. They can connect you to lots of opportunities and developers, and present you with opportunities to match your budget and requirements. And then if you wanted to go down the bespoke route, people like myself, we're on the ground, we're your eyes and ears, and we can go find suitable properties to meet your brief. Also, property managers, you need somebody, if you're living overseas, you will need someone to manage that investment for you, like any investment really. But regarding just purely property investment, I think the main factor to consider is the number crunching and getting your numbers right. So really, for every opportunity I present to a client, I make sure they've got a full understanding of all the costs involved. And that could be purchase costs. So that would be the deposit or the purchase price, the legal fees, the stamp duty, surveys, anything like that needs to be carried out. And then also the running costs as well. So you've obviously got your expected income. So your gross rental income, so it's your yield, gross yield. But then you've got to think about all the costs and expenses you're going to incur whilst having this investment. So you're going to have property management, like we said, it's going to be finding tenants, drawing up the contracts, managing the tenancy. You'll need someone on the ground to do that for you. So factor that cost in. If there's service charges, so if the property is leasehold, there'll be charges there to look after the building, the upkeep, maintenance. If there's communal parts, or if there's, for example, things like a gym or concierge, all that can really up your service charges. So that's something to be aware of. There's also additional fees like insurance. Be wary of, might have to fork out some money for repairs and void periods. So those are kind of things to consider with the costs. And then really, if you want to make it a good investment, and obviously you want it to be a good investment, you've got to think about capital growth and your exit plan. And also I should have said tax, but that's coming on by Jamie later. But if to be a good investment, you want to make sure it's going to grow. And with that, it's exactly what Henry just said, is looking at the areas where you buy. The area, the location of a property is pretty much the most crucial factor really when it comes to holding a property's value. And think about where it is now. Is it a desirable area? What future plans or regenerational development is going to happen in the area? And just when Crossrail was announced in 2007, we had lots of clients buying along the proposed stations at the time. And now the Crossrail, which is now the Elizabeth line, that's all developed. And those people that bought at very low prices now, they've reaped those rewards and have made great investments. So, and exactly what Henry just said, the Trafford new stadium, that's an absolutely ideal opportunity there to seize upon. So fortunately for new build and off-plan developments, you have got a lot of that information already supplied to you. So if you go to Henry, for example, he will have worked with the developers, provide all that information, and it's pretty much there in front of you. And it really helps you make an informed decision. But obviously you should do your own research as well. And what I would urge people to do is research the developer. So ask the questions, how long has the developer been around? What previous projects have they done? And all those sorts of questions. So really give you confidence in the purchase. And then also look at the quality of the project, the fixtures and fittings, what kitchens and bathrooms are going to be installed. All this is making sure it's a good value investment and it's going to hold its value and grow for you. Obviously, comparables with our property portals like Zoopla and Rightmove, it's really easy to go online and do some comparisons, look at what's available in the area, what's already been sold, and what the demand and what's not been sold as well is quite interesting. So that's a good thing to obviously do. And then there is the price per square foot calculation, which lots of people do as a comparison, but you can't really use it always as an indicator because even within one postcode, you can get quite significant differences, but it's another indicator to use. So when we're talking about, so we talked about off-build new plan, but when it comes to resale properties, and we're going to focus on that a bit more going in future seminars, but for me, when people come to me and they want a resale property, this is a property that's been owned and lived in potentially, or actually just sitting empty. And yes, it could be a really good deal below market value, but what we do for our clients when we do our bespoke searches, we physically go to the properties and we need to look at the condition of it, look at any problems, anything, because anything can be done to a property, get the builders in, but it's all a cost and this eats into your profit margins. So it's all these things to factor in. And what we also do is when we go see a property, it's not just in the property, we step outside, we look at the community, the area, the vibe, how busy it is, noisy it is, there's traffic, people, noise from people. So all that's a really factor about the property that you're buying and the value of it. So all these things to consider. Which you can't really do from overseas, but obviously there's people on the ground that can do that. And then there's other things to factor in, kind of the locality, amenities. If it's near a restaurant, some people might think great, but actually there might be an extractor fan right next to you, which isn't great, and smells and noises. So all these things to consider, really. Parking's a big one, especially in London. So if it comes with off-street parking, but is it realistic? Around where I live, it's absolutely almost impossible to get a parking space. So all these things to consider, really. But what I would say is overall, there's the standard considerations and due diligence to do. But the UK is a great place to invest and lots of opportunity. But what I would urge people is to use the information available and the experts and professionals that are there for you to help you make a good investment.
Wonderful. Thank you so much, Sarah. Before we move on to Callum, I'd just like to let you know that there is a quick UK property survey, which is live as well, which should hopefully have popped up for you. Please do take time to complete that if you haven't already. It's completely anonymous and it just helps us with a bit of data gathering to help us steer our content and future webinars as well. So thank you, Sarah. Callum will come on to you next to talk mortgages. So how easy is it for non-UK residents to get a UK mortgage at the moment? What criteria do they need to meet and what kind of interest rates can they expect?
Brilliant. Thanks, Alice. Yeah, hi, everyone. So I'll start very quickly with a short word answer. How easy is it? The answer is quite. I think there is a big stigma around expats and foreign nationals getting UK mortgages. However, in recent years, we have seen numerous lenders open up. So, first and foremost, if you were buying a residential property, one of the big players would be HSBC. They are looking at foreign national income. They are looking at kind of getting into that if you were looking to move in the idea of coming back to live here. From an investment point of view, I think buy-to-let limited company mortgages is one way of going, or buy-to-let personal name. There is plenty of lenders that have now come out and are offering rates for this. I'd say going on to the criteria side, I'd say one of the big criteria factors, especially obviously for expats, would be, do you have a footprint in the UK? That can be bank accounts. Do you still keep a bank account or a credit card here? Do you already own property? But even that isn't if you haven't, that doesn't mean you cannot get a mortgage. There is plenty of lenders, again, out there that would do it solely on if you own a property anywhere in the world. Recently, we've seen a real upscale, and as I say, Henry kind of touched on it before. We're doing a few deals at the moment with expats, and it's something that we're really, really pushing for our business as well. It's the kind of expat world, foreign national, and it's just making it a little bit clearer. Everybody's circumstances are different. I think that's the big factor. So lenders have specific criteria, but we can sit down and go through numerous bits, and I'm pretty positive in the end of it, we will find a lender that will lend on these. Touching on to sort of the rates part of the world, as Henry touched on it again before, Bank of England base rate has decreased. That then feeds into the market and decreases rates across the market, whether that be a residential and expat limited company, and it's all taken into factor. So on the kind of that scale, we are looking at interest rates. If we look at trends, obviously this is not a guarantee and not in any part advice. However, looking at the trends, looking at market, rates look to be coming down. That's coming from big lenders, that's coming from specialist lenders, even commercial lenders. It all follows the same trend. So going on to rates to expect, there's a couple of factors that normally come into it. 2-year fixed rates and 5-year fixed rates are your big two. With 2-year fixed rates, and they are stressed differently. So for a 2-year, your interest stress rate is taken on by the rental income. So it's not based on your personal income. The same with a 5-year, but if you're looking for long-term investments, a 5-year fixed rate obviously isn't ideal if the rates are high, but as we can see at the moment, if you were looking to purchase in properties over the next couple of years and the market, as I say, is getting more stable, a 5-year fixed rate is stressed and based on the rental income. So rates to expect. Rates are starting from about 4.29%. on an expat rate for a 5-year and a 4.49% rate for a 2-year. That also, it does have factors, and there are product fees available in different levels, but what we would look to do as a business and working together would be to find you the best overall deal, whether that's what might be a slightly higher rate with fees, and they decrease by a percentage rate normally.
Brilliant. Thank you so much, Callum. We will come to Jamie next, and then after Jamie has given us an overview of the tax, we will come to questions. So if you do have a question for any of our panelists about anything that's been discussed today or anything that hasn't been discussed that was a question you had, please do pop it in the Q&A and we will come to that section next. So Jamie, over to tax. What are the main tax liabilities that non-residents need to be aware of when investing in UK property? So how is, for example, rental income taxed? What capital gains should they expect to pay when they sell? And are there any other tax considerations they need to be aware of?
Okay, thank you, Alice. There are several tax considerations to be aware of if you're buying UK property. The major one and the most punitive, which Alice didn't actually mention, and is SDLT, which is the stamp duty land tax, which you need to factor in when you're making a purchase. Due to pressure within the UK in recent years, more punitive SDLT rates have been introduced, which unfortunately do penalise non-residents of the UK that are looking to invest in UK property. We have special rules that apply to non-residents, and we have special rates that also apply to investors that already own property and as a result of the UK purchase will own more than one property. There's a special rate that applies there. So the standard rates of SDLT that will apply from the 1st of April range from 0% on properties up to a value of 125k, and then are banded up until a 12% rate for the portion of the property value over 1.5 million. There are bands in between, but we don't have enough time to get into the detail on that. Now, they're fine. So if you're subject to the UK rates, you're not a non-resident, perhaps you're replacing a main home and aren't buying an additional property, then, for example, if you were spending 500k on a UK property, your stamp duty land tax liability is going to be £15,000 from the 1st of April on a 500k purchase. Now, to put into context, the more punitive rates that apply for non-residents or those buying second homes, if you're a non-resident, you pay a 2% surcharge in addition to the UK rates on your purchase. So on a 500k purchase, there's immediately an extra £10,000 stamp duty land tax liability that you need to account for. So you're moving from 15k to a £25,000 SDLT liability on your purchase. Following that same example of a £500,000 purchase, if you also already own a property, whether it's in the UK or overseas, you will pay a further 5% SDLT surcharge on the purchase. So you're moving away from 15 to 25 up to £50,000 liability on your acquisition. Now, the good news is if you're a non-resident and you're looking to buy the UK property and you incur the 2% surcharge, providing you become UK resident within broadly, you spend more than 183 days in the UK within a year of making that purchase, then you can apply for the 2% surcharge to be refunded, which we can help with. With regards to the additional property surcharge, if you are buying the property as a main home and you sell your main home within 3 years of making the purchase, then again, you can go through the process of having that 5% surcharge repaid, and we can help with that. That's SDLT. Different rates apply if you're buying property for a company. We don't have time to get into all of the corporate rules today. alongside SDLT, if you're buying the property as an investment, your rental profits will be subject to income tax if you're buying as an individual or as a member of a partnership. If you're subject to UK income tax, then normally you would register as through the non-resident landlord scheme in order to avoid the estate agent having to withhold 20% on your gross rental income that you receive. If you're subject to income tax, the first £12,500 pounds more or less of your income isn't subject to tax. It's effectively a nil rate band. Any profits which fall between that 12,500 and a £50,000 are subject to our basic rate of income tax at 20%. Above that, it's 40%. Above 125k, then you've got quite a large portfolio, and you're in the 45% tax bracket. If you are making your acquisitions through a company, different rates of tax apply. The corporation tax rate in the UK starts at 19% for profits up to 50k and goes up to 25%. One thing to bear in mind is with regards mortgage interest. If you've got finance on your property and you own the property direct in your own name, then if your rental profits take you out of the basic rate tax band that I've just mentioned, so you're making more than 50k in profit, then you will start to suffer a restriction on the relief that you can get, the deduction that you can claim against your profits. Effectively, once you're in the higher tax bracket, then you'll start to only receive relief on 50% of the interest that you're suffering. So it's income tax, SDLT, capital gains tax. So if you make an investment in a UK property and you sell that property, you have to consider our capital gains tax rules. If this is a pure investment, then you're going to pay capital gains tax on the profit that you make on the sale, net of any costs. If the property has been brought as a main home or previously been used as a main home or used as a main home at some point, which is a common scenario for expats that are leaving the UK, perhaps returning to the UK to a home that you had prior to your departure, then you might qualify for the principal private residence exemption when you sell the property, basically exempting any period of occupation from tax on a straight line basis for the period of your ownership, and also exempting the last 9 months of ownership, regardless of whether or not you move back into the property. And there are further special reliefs that might apply to our expat clients that are tuned in today. For example, if you leave the UK to take up an employment, retain your UK property, rent it out whilst you're away, providing you return to the UK and move back into the property, you should qualify for the main residence exemption for the full period that you're outside of the UK. Non-residents can still qualify for the main residence exemption. You have to be in the UK for a minimum of 90 nights in the year and have and at some point nominate the UK property to be your main home, and it needs to be used as a main home rather than an investment. Capital gains tax, we have an annual exemption of £3,000. Any gains over and above that amount are taxed at 18% if the gain falls within the basic rate tax band, 24% over and above that. Inheritance tax, you're going to have a UK asset once you make a UK investment. That the value of that asset for UK estate tax purposes is going to be the value of the property less any debt that you have on the property. And then in order to calculate what your estate tax liability might be, you factor in our nil rate band for inheritance tax purposes, which is £325,000. And we also have a residential nil rate band of up to £175,000, which could apply in certain circumstances. Any value over and above that 325k or 500k is potentially subject to inheritance tax at 40%. All expats invested in UK property need to ensure that you have the right wills in place in order to mitigate your exposure to that estate tax, and consider taking out life insurance if you do have UK exposure. Although that might be difficult if you're non-resident, you'll need to consider taking out life insurance wherever you're resident. It's difficult for non-residents to obtain UK life insurance, not impossible, I believe. And I think that's about all I have time for now, Alice. Rattled through it.
Fantastic. Thanks, Jamie. There's always so much to cover from a tax perspective in these sessions, so that was great. Thank you. So yeah, we'll move on to the Q&A section now. So please do use the Q&A function on the chat if you have any questions. We have had a couple come through. So the first is a tax one. So we'll come to you, Jamie, first. So this is around SDLT. So this person says, I'm a UK non-resident. I have about 200k of equity on a UK buy-to-let property that I want to release in order to purchase 2 further properties of about 250 to 300k. What would my SDLT liability be on the 2 new properties?
Use a calculator, work out your normal UK SDLT is going to be on the value of those each property. In addition to that rate, you have to add a further 7%, which is the 5% additional property surcharge plus the 2% surcharge for you as a non-resident. I don't know off the top of my head what the SDLT is on 350k.
I've got a calculator up. I've cheated. Sorry, Jamie.
Right, go on. Tell us
so just taking a kind of average property price of £275,000, it would be £20,500 per property.
Brilliant.
And that applies to a buy-to-let investor who is a UK non-resident.
Is that, and then so that's with the additional rates and the non-resident rate. There you go.
Fantastic. Excellent. Live maths. Well done, Henry. Thank you so much. Thank you, Jamie. Question for Callum. Did Callum say that HSBC take foreign income into account for mortgage applications?
The short answer is yes. It's if it is in personal name. So if from a foreign mortgage application in personal name and buying for residential purposes, then HSBC they can consider foreign income.
Fantastic. Thank you, Callum. And another question for you on mortgages.
No problem.
I have no properties and I want to spend 250k on a property. No permanent address as work takes me many places. Is a mortgage possible or is a cash purchase the only option?
Short answer, yeah. I mean, short answer, it can be possible. I'd need a bit more details, so more than happy if you drop me an email to have a look into it for you.
Fantastic. Thank you so much, Callum. Okay, moving on to our next question. Potentially this is one for Sarah or Henry, so feel free to jump in. What is the difference between a leasehold and a freehold property? And I've read that the rules are changing. How could these potential changes affect a property investment for me?
Give it a go, Sarah. You can mark my answers. 2 types of ways you can own a property in the UK. You've got leasehold and freehold, and whoever's asked this question is right. There is leasehold reform. So broadly speaking, if it's a single property, i.e. a single house, you will own the property itself and you will own land that's under it. That is a freehold title, so you own the property and the land. Generally speaking, if there's more or multiple properties, i.e. an apartment block on the same plot of land, historically it's been a leasehold system. So anywhere from probably 150 years to 999 years, you will own that apartment. Let's say in 999 years' time, the person who owns that apartment forgets to extend that lease. They simply have to give that property back to whoever the freeholder is. And it's usually the developer, it could be the city council, it could actually just be an investment firm. So that's how it's been. Now there's going to be leasehold reform, and what they're looking at doing is moving to a common hold system whereby if you've got 100 apartments on a single plot of land, each apartment owner has a share of that land as well. And it makes it a lot easier and a lot more equitable, because what we've seen in the past are problems whereby the developer might have sold the freehold to an investment company. That investment company is very money motivated, and within the terms of the lease, you would have ground rent. And there might be a clause in that lease that says every 2 years or every year, the ground rent doubles. That would probably be Callum's worst nightmare, because every single mortgage lender in the world would say, I'm not going to give you lending on that because that's an unmortgageable property. So that's what the government's trying to stamp out, and they're trying to make it a lot fairer and a lot easier for people to buy their properties.
Thank you, Henry. Sarah, did you have anything to add?
No, couldn't have said it better. Sometimes in the past, though, if you've got a small development, people used to get together and buy a share of freehold. And also there's a problem with getting mortgages, Callum will know, if you get under a certain number of years left on the lease. And sometimes you can see these incredible deals in Chelsea, like, how come is that property so cheap in that area? And it's like, it's got about 15 years left on the lease. So you literally own it for 15 years and then it'd be gone. But sometimes people actually do still buy that because it could make a good investment. So yeah, but I think it's a good change coming in.
Brilliant. Thank you, Sarah. Callum, did you want to make a comment on the leases and mortgages?
I was just going to say, so when a lease starts running down, most mortgage lenders, anything under 75 years, becomes a little bit harder. But that's not to say that leases can't be extended. It's just finding the right channels that can be done to do it.
Brilliant. Thank you, everyone. So we've got a question now, potentially for both Jamie and Callum. I'm about to buy a residential mortgage for my return to the UK from the Caribbean where I work. I would like my mum to live in this property, though not pay rent. Are there any issues with regards to tax or mortgage that I might experience?
No issues from a tax perspective, I would say.
I would say from a mortgage point of view, it would determine on when you potentially are coming back. So if there is a plan in place, there is lenders that will take that as an option. But again, a lot of this questions with mortgage, it comes down to specifics and individuals' criteria, because lenders are all different.
Thank you both. So next question we have, potentially this is one for you, Henry, and the answer may be that you will have the information when we come to our where to buy webinar. But someone's asked, do you have any information on price trends for flats in Cornwall, in kind of coastal town or village with a view for my family use and rental?
Off the top of my head, no. What I would probably say is from a kind of personal standpoint, and also maybe operating it as a holiday let, would be a good opportunity to earn some additional income. Jamie might have 1 or 2 points to add, because I know holiday let rules are changing in terms of how they're taxed. The government probably is moving to a direction of clamping down on that, because they're trying to increase the amount of houses that are being lived in long term as opposed to rented out short term. But I know that a lot of our clients do in certain areas, in seaside towns or city centres, buy properties in order to operate them as serviced accommodation, because you can receive a much higher rental income.
Thank you, Henry. Jamie, was there anything that you'd like to say about a tax on holiday lets?
Yes, the rules for furnished holiday lets have been more favourable historically, but we're moving towards them being taxed on a similar basis to a normal buy-to-let property regime. So clearly, if you're renting the property and making some income and some profit, then you'll need to register and declare that as normal.
Brilliant. Thank you, Jamie. Next question for Callum is around fees. So what kind of, as a buyer wanting an expat residential mortgage, what kind of fees can I expect to pay if I go to a mortgage broker?
It's quite a difficult one. I mean, if the fees is about the broker fees paying, there is no set fee and it's kind of, it has to be a form of consumer duty, obviously. However, if we're talking about the total fees being from what to expect from a lender as well as this, they can be quite high. For example, if it is classed as the product fee that the lender is charging, that could be upwards of 7% depending on the rate. If it's a case of the mortgage broker fees, obviously every firm is different, but it should have been labelled to you in the outset before any application was made.
Thank you, Callum. The next couple of questions are kind of around the same line, so I'm going to lump them together. So somebody's asked, and again, the answer may not well be straightforward. It may be that it's personal circumstances. But someone's asked, is it better to go down the buy-to-let route through my limited company registered in England and Wales, or is it better to buy as an individual? I've got no property in the UK. And then the next person's asked, what are your views on personal ownership versus a limited company, especially if the property might need some refurbishment?
Yeah, there is the two ways, obviously personal name and limited company. I think this may be more of a question for tax advice, because that is one of the main attributes that come into the factor whether buying through personal name or limited company. From a mortgage standpoint, again, every lender's different. A lot of lenders will, almost all lenders in this kind of sector will accept both. But yeah, I would say seek tax advice mainly on this.
Jamie.
We can provide. It really does depend on your long-term strategy for your property investment. If you're buying one property, is it really worth going through the complication of using a company and the administrative burden that brings? I think probably not. If you're building a large portfolio and you're investing for the long term, then using a company to build that portfolio is often favourable, particularly due to some of the things I mentioned around mortgage interest restriction, that type of thing. If you're buying a property eventually to use for your own personal use as a family, then you should never use a company, because there are penalties, penalty charges which would apply to that. We have a something called the annual tax on envelope dwellings charge, which applies to properties over a value of 500k. If they're owned through a company and used personally, then you get penalised. If you purchase through a company for private use, again, you're penalised on the SDLT rate that you might pay. So it really depends on long-term strategy. With regards developing the property and having to make further investments, I don't think that is really a driver for personal or corporate ownership. I think we're really focused on long-term strategy and avoiding the complications of corporate ownership, double tax charges and things like that.
Thank you very much. Another tax question. Always lots of tax questions. For stamp duty, land tax, is it the case that a non-UK resident pays a punitive rate if that person owns a property somewhere else in the world? What is the rate and how can the UK authorities verify the ownership?
Well, stamp duty land tax is a self-assessed tax, so and is normally dealt with by the solicitor or lawyer that assists you with the conveyancing. So you will get asked by your solicitor to confirm whether or not you own property overseas. So that's the self-assessment process, and you make that declaration. If you do, they will apply the 5% surcharge, and some of those rules around, if you're buying a main home and replacing a main home, things like that may be relevant later on. So it's assessed by the conveyancer when you complete on the purchase. HMRC have 12 months. A 12-month inquiry window to check returns that are filed, and do sometimes verify whether or not the amount assessed is correct. The additional rate for non-residents is 2% in addition to the normal stamp duty land tax rates that apply.
Thank you, Jamie. Callum, a question on mortgage rates. Would having a UK credit card, which I don't have, help reduce the mortgage rate? I have a UK bank account, if that helps too. Will lenders check overseas, in my case, US credit history?
The short answer is having the footprint is not going to make any difference to your actual interest rate. However, the footprint in the UK would maybe allow you to access lenders that have got a cheaper rate. Again, it's a very, very difficult overview. Every single case is specific, and it is something that we could run through if you wanted some more information.
Brilliant. Thank you, Callum. Question for either Henry or Sarah, or a combination of the two. Which type of property offers a better long-term growth, a house or a flat?
So it really comes down to location and lots of other factors between house or flat, really, to be honest. I mean, if you were looking at a specific area, then we could probably answer the question a bit more. A house is probably going to be freehold rather than leasehold. It's all about demand as well, really. So yeah, if you got the house, you could split it into two flats.
Yeah, I agree. It depends on the location. I think if you're looking at, for example, an old leasehold flat that has high ground rent issues and has a short lease, and maybe has cladding that's going to need replaced, so it doesn't have what's called an EWS1 form. Again, one of Callum's nightmares. Just means it has unsafe cladding. That's gonna be capped. So you're always going to be better off looking at a house. If you're looking at a new build, that comes with all the new regulations, it comes with a new leasehold, it comes with a low service charge, it's located in an area that's up and coming regeneration, that's backed by local government, that has a defined 30-year regeneration plan, you're probably going to see more growth for that flat than you are for a house that's maybe located on the outskirts that probably needs a bit more maintenance and upkeep. So I think it really depends on what you're looking at. We would always advise people to look at core city centres. That's where we see the most rental demand. That's where these young populations of generation rent are. But you will get these pockets of houses on the suburbs. And if that is your strategy, then someone like Sarah is great to go with, because she'll be that kind of buyer's agent and she'll be able to find the best one.
Thank you. We've had a few questions come in around maximum age range on mortgages. So I'm going to kind of lump them together and go to you, Callum. So could you say a little bit about what challenges a retired person receiving a pension might face when they're trying to get a mortgage?
Yeah, so from a residential perspective, where your income is taken into consideration, it's a house that you plan on living in, then usually lenders are capping at 75 now, with a pension. If it is based on a limited company buy to let or a personal name buy to let, the actual age range is going up to in excess of about 95 now. So there is caps. Again, every lender is different, but going up to is a kind of regional scale. Personal name for residential, I'd say around 75. There is a couple of lenders that can go a little bit higher. But for limited company investment properties, I would say it can go up to about 90 to 95.
Thank you, Callum. I'm just looking through the questions. We've only got 5 minutes left, so I'm so sorry if we don't get to your question, because we have had so many, which has been great. We will capture them all and do our best to answer them in future content. So somebody has asked, I have 3 rental properties in the UK. I'm in the process of buying another. I can raise enough for this purchase by increasing the mortgage on one of my existing properties. Is this a good idea, or should I take out a mortgage on the new property? Callum, that may not be a straightforward answer, but do you have any insights?
Again, I think it comes down to personal. They are 2 options. And what I would say is, talking to a mortgage advisor would have a look at your portfolio, have a look at your current circumstance, and kind of advise you what the best way to go. I think from that perspective, it will depend on how much money you have. You would still have to leave approximately 25% of the value in there. So you could take out the 75% loan to value. But it will be a case of looking at your portfolio as you have 3 and looking at the best way to maximize what you're looking to do.
Thank you so much, Callum. Henry, one for you, I think. I'm just starting out in buying UK property and have just purchased my first off-plan one. When starting out with investing, is it better to purchase off-plan or already owned?
Good question. Depends on the strategy. I'd love to give a more specific answer. So, the benefits of off-plan are you can get into a scheme early, you can pick out the best units, you can sometimes get a discount, and you don't have to complete straight away. So the benefit of that is, if we're speaking to a mortgage broker and if we're looking at Bank of England base rate predictions, and we, take a bit of an educated guess that the base rate is going to be lower in 2 years, you're going to be completing in a more favorable financial environment. So in that case, off-plan property could be a good option. On the other hand, you know, it depends on your strategy, depends how active and or passive you want to be. If you want to be quite an active investor and you find a below market value opportunity that requires a bit of renovation and a bit more hands-on care and attention, you can make money doing it that way. What I've found from working overseas is a lot of international and expat investors, they don't have that time. That, you know, they want these kind of passive investments, and that's why off-plan and new build property tends to be a bit more popular, because people can do that armchair investment and just let it run itself.
Thank you, Henry. Sarah, did you want to add anything to this question?
So there's positives, as in what Henry just said. You know, you're not having to do the immediate cost up front. You can get in there, get discounts early, all that stuff. Having a property straight away is immediate income. You own something, and then and also it comes down to the properties really and what you're going to get. Yeah.
Thank you, Sarah. And that leads us really nicely onto the content of the next webinar, because we are almost at time. So that is all we have time for today. I'm so sorry if we didn't get to your question, but we do have 2 more property webinars coming up. So again, we'll send the link to everyone who's attended with the next 2. But if you go to expertsforexpats.com /events-for-expats, and we'll pop that link in the webinar chat as well, you will see where you can register for our next webinar on resale versus new build on the 27th of March, and then where to buy. So where we'll be going into more detail, looking at specific regions on the 8th of April. So thank you so much, everyone, for coming along today, for joining us. Thank you so much to our panelists for sharing your insights. And I do apologise, as I say, if we did not get the chance to get to your question today. We have captured them all and we'll do our best to answer them in future content. If you would like to speak to an expert to get a free discovery call to help you with your UK property investment, you will again find a link in the chat to complete a form to request an introduction, and we will also email this to you after the session as well, so don't worry if you don't manage to catch it. You will find plenty more blogs, guides, resources, articles on our website, expertsforexpats.com, if you are looking for more advice around property investment or in any other area of expat tax, finance and wealth management. So thank you again so much to our panel, and thank you everyone for attending today. Have a great rest of your day.